Hello and welcome to today's week ahead. And of course, once again, we have the US in the spotlight. The week just gone did see Donald Trump visiting the Chinese. And whilst we did see some relief at times, really the theme around the ongoing blockade of the Straits of Hormuz continues to be central for markets. And we're seeing that continue to play out. And we will probably do so once again in the week ahead. Alongside that, we have particular attention for the UK with the inflation data coming out amongst a whole raft of key data points from the UK at a time when, of course, there's some pretty significant upheaval on the political front. So let's kick things off with the overall week ahead. According to Trading Economics, these are the top tier items. And we can see here that things really start to get interesting straight away on Monday. Industrial production and retail sales heading up a whole raft of data points out of China. Then on Tuesday, we've got GDP out of Japan, consumer confidence in Australia, the RBA meetings, of course, meeting minutes. That, of course, comes after yet another rate hike. Then we've got the jobs report in the UK, inflation in Canada, where it's expected to jump up to 3%. Once again, inflation in the UK, that's expected to decline. Remember, I've spent the best part of a year waiting for this very moment. Well, we're down to 2.6, but from here, probably the only way is up. Fed minutes on Wednesday as well, the balance of trade data out of Japan, and we've got PMIs across the spectrum on Thursday as well. Building permits, housing starts out of the US, and then ending things with the inflation data out of Japan, consumer confidence out of Germany, the retail sales number from the UK that wraps up a very busy week for the UK, and then the EFO business climate figure. And so let's kick off with the UK. As you can see here in totality, Tuesday sees the jobs report, Wednesday sees the inflation report, Thursday sees the PMIs, and Friday sees retail sales. The jobs report, of course, as you can see here, has been relatively delayed in nature. So when we've been looking in the past, it's always been something that's not necessarily been that relevant given the crisis in Iran. Now it's starting to become more relevant because it is the March release. The expectation is that we see a jump in terms of unemployment up to 5.1%, with the claimant count remaining elevated at 20 from 26.8 up to 32K. So expectation is a worsening of the jobs market, which means that the Bank of England, which of course is struggling with the notion of elevated inflation, may feel the need to do something in terms of on the dovish side. It may not be a rate cut, but it may be the desire to come out with a more neutral tone. The other side, of course, is the inflation picture, and the inflation picture sees the potential for a sharp decline down to 2.6%. And I'll explain exactly why. The core reading down to 2% from 3.1. So suddenly it starts to look all right again. Core inflation back at target. So you could say, well, there's no need for the Bank of England to be hiking rates. Well, that may not necessarily be the case, but we'll see. So inflation on the PPI perspective, also notable. We just saw the US PPI number coming out in the week just gone. And that was the big ticket sort of item in terms of the thing causing concern throughout markets, because we saw a significant jump. And of course, factory input prices, when you're seeing a energy crisis like we're seeing at the moment, well, that essentially means that you're probably going to see the first price impact coming into the factories, coming into the businesses. That's the PPI input part. Then you see them passing it on to consumers. That's the PPI output part. And then you see that coming into consumer prices. That's the RPI and the CPI. So in terms of the PPI input figures, there's an expectation that that's going to come in at 0.5 for the month, down from that massive 4.4 figure last time around, but the year-on-year figure up to 5.8. Then the output figures, again, expected to come in weaker than last time around in terms of the March figure really being the one that did the big damage, but still elevated, and now looking to see that overall sort of PPI output figure up to 2.7%. Remember, the inflation data is April, the jobs data is March. In terms of the data from a PMI perspective, you can see actually things have been pretty good, but there's an expectation that's going to pull back quite significantly for the month of May. And so there have been some concerns that essentially the strength that we saw last time around and throughout sort of March and April really had been a case of front loading purchases, building up inventories ahead of the likely price shock and supply shock that was coming with the closure of the Straits of Hormuz. That's seemingly what's happening here. And now businesses are just left to deal with the negative consequences of the ongoing blockade in the region. And so again, weakness. So we've got weakness expected for the jobs market, weakness expected on the PMI numbers, and then a sharp decline expected in terms of inflation. Retail sales, how are things looking on this front? A decline on a month-on-month figure, a decline on the year-on-year figure. So all in all, it's a case of a weakening economy and a lower figure in terms of the CPI numbers, inflation this time around. That's what markets are expecting. Remember, that doesn't mean that's what we're going to see. In terms of some of the key things that we're looking out for at the moment, the UK in particular has seen borrowing costs surge. That is essentially treasury yields. And you can see that the sharp rise that we've been seeing and remaining elevated and grinding higher of late. Now, of course, at the moment, there are big question marks around the leadership of the Labour Party. We've just seen the local elections. And of course, as many anticipated, it's the Greens and Reform that really started to gather sort of significant support. And it's the traditional parties, the likes of the Conservatives and Labour Party, that sort of come into the firing line. Of course, the Tories didn't have great numbers anyway at the last major election. And therefore, it's really the Labour Party where you suddenly start to see the likes of Wes Streeting and like trying to make moves to essentially overthrow Keir Starmer's leadership. Now, whether that happens or not remains to be seen. But of course, whenever you see political upheaval, political uncertainty, you generally see a rise in terms of borrowing costs. So it's not to say everything that we're seeing right now is because the markets are really worried that it won't be Keir Starmer at the helm. Certainly, it doesn't help when you don't necessarily know what the future may look like. And that also stands for the idea that we could end up having a reform government, which who knows what their policies are beyond immigration. And therefore, you've got question marks over exactly what that means in terms of the economy. And again, that sort of increases instability and raises borrowing costs. On the inflation side of things, like we said, we're over 3% on headline and core. But if you look on the back end of last year on the month-on-month figures, we've got 1.2 for the core figure, 1.2 for the headline figure, 1.4 for the core figure for April. So those are massive monthly figures that, of course, if we just see a normal figure, let's say we see 0.3 for the month, all of a sudden you see a near 1% drop. And that's why we're expecting to see the big disinflation coming into play for this time around. Because essentially, if we see anything like a normal figure for this April, then we're going to see the base effects really kick in and we come down into the twos. That's what markets are anticipating right now. Like I said, their market predictions are for a drop down to 2.6% on headline from 3.3, so a decline of 0.7%, and then a 1.1% decline in the core figure, all the way down to target at 2%. And you can see that essentially we're looking for the same, right? Because you can see that 11-month annualized reading at the bottom with the headline figure at 2.23, the core figure at 1.93. So essentially, if you take the last 11 months, find an average figure and say, if that 12th month, once we replace that April, looked like an average figure of the last 11 months, what would headline inflation and core inflation look like? Well, exactly how markets are predicting, really, a touch lower, but yeah, 2.2 and 1.9 rather than 2.3 and 2%. So yes, you know, that is encouraging, but then you look at what's happening more recently. The February reading was above where we want it to be. The March reading was definitely above where we want it to be. And then this time around, we're probably going to see the same in terms of the April figure. The headline monthly figure is expected at 0.5. Again, it's above where we want it to be. So we may see a sharp decline this time around, and maybe markets react to that with glee. But then you also have to consider the notion that this is going to be a bottom. And from here on out, it grinds higher. And then we might end up spending over a year trying to shake out these monthly figures that we're currently starting to build up now. So just as we got rid of that big April figure from last year, we start to build a whole tranche of above target monthly figures that, again, we'll have to wait another year for that to be stripped out and for us to get back down towards the 2% target. The jobs market, you can see here, unemployment rate, are we going to see a sort of significant uptick in terms of unemployment? That's what markets are anticipating. The claimant count has been on the rise. But bear in mind, this time around, markets are anticipating weakness in terms of some of the economic data and weakness in terms of the inflation data. Last week, or the week just gone, which I'm filming within, we actually saw a better than expected GDP figure out of the UK at 0.3. So you could look at the last month-on-month GDP figures and say, actually, the UK is in pretty rude health. I wouldn't necessarily go as far as that. It's likely we're going to see some significant swings. Much of it is going to be front-loaded inventory building ahead of a price shock and a supply shock, given everything that's happening in the Middle East right now. And so, certainly, the GDP figures don't look too bad, but I would take that with a few grains of salt, to say the least. So in terms of where things stand from a sort of monetary policy perspective, you can see that markets right now pricing in a 36% chance that we see a June hike. Beyond that, markets are much more confident that we see it in July with a 66% chance. And then you could actually see additional hikes at the back end of the year. So markets right now, as a base case scenario, are pricing in 2 rate hikes for this year. Of course, this comes amid great uncertainty over exactly what's happening in terms of the inflation picture. But certainly the longer that this goes on, the more likely it is that we do see a lasting inflation shock, of which members from the Bank of England have come out and said that they'd be willing to act. So they're not necessarily as pro-growth as, say, the Federal Reserve, of which they're mainly sort of sitting on their hands. The Bank of England seem like they are willing to hike despite the fact that rates are already elevated and the UK economy is in trouble. They just don't want another major inflation shock on their hands. In terms of markets, let's just take a look at the euro against the pound. Now you can see here that price has started to turn higher once again. And so notably, with that weekly candle looking to close out with another area of lows, you can see here we've got the structure of lows here. We've sort of seen this pullback. And so it's a question of, are we going to see the euro coming into strength against the pound? Now, notably, like I said, the expectation is that we're going to see weak data in terms of, say, the PMIs, the jobs data, but also a sharp decline in terms of UK inflation. And if all of that comes to fruition, it does point towards a possibility for the near term of some weakness for the pound, as people think that potentially the Bank of England aren't necessarily going to need to hike rates to the degree that we've just seen in that previous chart. So a break through that 0.874 certainly gives us greater confidence of that push higher from here. With the fact that we've repeatedly come down to this 862 support structure and not broken through that level, a move through that resistance level means that we end the creation of lower highs, building on that flatlining low. Essentially, you've got this descending triangle formation with an upside breakout from there. So if that's what we see, if we see that 874 broken, it could provide us with a move towards the upside here for euro against the pound. And then, of course, we can't do a weekly show without talking about Iran. And what we're seeing here is that the story at the moment is around inventories as much as anything. This is US commercial inventories, and you can see here with the sort of dotted line, the sort of left side of this chart, they're turning lower much earlier than you would anticipate for this time of year, essentially. Normally, they would turn lower later on in the year as we go through driving season and like. Well, right now, we're seeing US inventories being drawn down. And this, of course, is a theme that we're seeing around the world. They're trying to mitigate the effects of the blockade. And to an extent, they have been doing relatively well on that front. However, as the inventories get drawn down, and certainly as the allocated inventories have already been drawn down, there's a question mark of, do you do more, or do you essentially let the market effect really start to take hold? That is the concern, that essentially the stability, the stabilizing effect of the actions being taken thus far start to run out, and therefore you start to really feel the impact on oil prices, and that could really hurt markets in a significant way. Now, notably over the week just gone, we've seen relatively positive tones coming out of the US and China. Of course, a little bit spiky in some places, but certainly the Chinese opting to lay out a plan to buy a huge amount of airplanes from Boeing, and we'll probably see more as we're coming into Friday right now. There is a talk of wanting to find a solution to the events in the Middle East. There was apparently a admittal from the Chinese that the Iranians shouldn't get a nuclear weapon. But ultimately, Iran will do what's right for Iran, and they're going to squeeze this for everything they can. And certainly as things stand, we're at an impasse. So any sort of short period of optimism really appears to be brief and short-lived, and then soon enough you come back into a position where markets remember, oh yeah, the straits are still closed, we're still in the same position, and all of those inventories are being drawn down. We're seeing shortages continue to build because, of course, those ships that originally set sail have all pretty much docked now, and there's none behind them. And so you're likely to see cracks appear over the weeks that come. And in terms of market pricing, we can see that essentially for oil, if we were to go on to Brent crude, you can see that starting to turn higher once again. Of course, we've seen plenty of chop at the moment, and there's a hope that this is the high, this is the peak, but we don't necessarily know. And a lot of this is going to come down to the tone coming out of the Middle East. And so this is what's difficult for traders. You can't really anticipate exactly what's going to happen from one day to the next. Will Donald Trump come out and say that they're very close to a deal, or will he say that they're about to bomb new targets in Iran and kick off the military campaign once again? Likely Donald Trump's going to do his best to try and sort of tread the two lines, because by threatening to bomb, he thinks that he can bring the Iranians to the table and get concessions to finally bring an end to this crisis. But if he continues to say that, then markets suddenly react. So instead, he has to flitter between saying that he's going to bomb their bridges and their power stations, and then with the next breath saying, oh, you know, we're making great headway and we're close to a deal. And that brings down oil prices. At the moment, we're seeing prices start to turn higher once again. You can see a move through this 103.5 kind of area, gives us that next leg higher after the creation of intraday higher lows. So we're sort of grinding higher, and as we grind higher, that then takes a toll on, say, gold prices, silver prices. It lifts the US dollar and the like. Of course, higher oil prices do put a dampener on equity markets, but the tech space has sort of helped mitigate that to a great degree. Nonetheless, as we head into the new week, I guess it's more of the same, right? So if you are trading it, you've got to keep abreast of the news. But really, this is a case of just trading it on this sort of short-term basis in my mind, and keeping those stop losses well and truly in place. You know that at some point you're going to get hurt, but then you've probably got an equal chance to get to benefit from the news as well. But it's a volatile one at the moment. You've of course got to be aware of that. If you're looking to trade around the news itself, markets are probably going to have moved by the time a headline comes out. So that's quite difficult. Of course, algos sort of taking control on that front. They'll be well ahead of the game. But certainly as things stand, we're starting to regain ground. And the longer that this goes on, the path of least resistance is towards the upside. But of course, you're coming up against the US government and the US president as he tries to keep a lid on oil prices. I hope that's been useful for you guys. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and a great week ahead. Thank you.